I guess I can say good afternoon at this point. It's so great to see everybody here today. Before we dig into the content, I just want to start out by giving a big thank you to the team at Experian. We really appreciate the sponsorship, and we, after a couple of years not doing this as much, it's really nice to be getting back to normal and getting everyone together, and it's sponsors like Experian that make that possible. So thank you very much. So today's topic, this topic is Buy Now, Pay Later 2.0. Where do we go from here? Today we're going to talk a little bit about some of the different regulatory changes, some of the different competitive challenges in the economy, and just new innovations that we're seeing in Buy Now, Pay Later. We're really excited about this panel. We have Erica White from Affirm, Albert Piriou from Zilch, Jeffrey Rogers from Lift Forward, Mia Huntington from Elevon, and I'm Justin Hosey. I'm a partner at Hudson Cook. We're a law firm focused on compliance with consumer protection laws. I think what I'll do first is maybe turn it over to each of our panelists to just speak for a moment about themselves, what they do at their respective organizations, and just their organization's philosophy. And then we're going to dig into looking into the future and figuring out where Buy Now, Pay Later goes from here. Why don't we just go in order? We'll start with Jeffrey, and we'll move down the line. Jeffrey?
Okay, great. Jeffrey Rogers, CEO of Lift Forward. We have an embedded finance platform. We integrate in financial institutions, mostly banks, but we also work with traditional Buy Now, Pay Later companies into merchants for, I would say, financing programs. Of course, we do Buy Now, Pay Later, but we do the whole gamut, all the way up to installment loans and also revolving credit. We're omni-channel, so we're at the point of sale online and also in call centers.
Hi, everyone. Thanks for coming. I'm Erica White. I'm the Vice President of Marketing and Communications at Affirm. Affirm is a transparent alternative to credit cards. We were founded about 10 years ago to build honest financial products that improve lives. That's our mission. We started with an alternative credit product that you can probably see at the likes of Amazon, Walmart, and Target. And we help consumers pay over time in installments ranging from 6 weeks to 60 months. That's the gist of it.
Mia Huntington. So I work for a company called Elevon. Parent company is actually U.S. Bank. Elevon is the merchant acquiring division of U.S. Bank, and we are just getting started at looking at, as a bank, entering the space of point-of-sale lending and Buy Now, Pay Later.
So Al Piriou, CEO for the U.S. business for Zilch Technology. We span both the U.K. and the U.S. Bit of a different take on BNPL in that we are a credit card, so an installment loan card, where you can use it wherever MasterCard's accepted. So we're not at point of sale per se. We issue a certain amount to an individual, broken out over a 6-week payment structure, and use it wherever MasterCard's accepted. So spanning the US and the UK, about 3 million users across both geographies.
Perfect, thank you, and thank you again for participating on the panel, all of you. We really appreciate it. I think I'll start with Erica. I'm going to ask each panelist a question, but I want to invite all panelists, obviously, to chime in, and let's have a nice discussion. And also invite the audience, please feel free to use the technology, use the QR code as we near the end, and we'd love to answer your questions as well. Erica, just want to start with a discussion about the competitive landscape in Buy Now, Pay Later. Many who are in the room just heard a discussion about credit cards and some of the interplay between credit cards and Buy Now, Pay Later. Can you just talk broadly about the competitive landscape and what you're seeing?
Sure. A couple thoughts on this. So firstly, I think the increased amount of parties entering the competitive landscape validates that BNPL, pay over time solutions, credit alternatives are really here to stay. I think there were some people who probably thought this was a pandemic fad or something you might use to buy a Peloton once, but all the players coming into the space really validate that it's here to stay. For Affirm specifically, I think we're unique in a couple ways. Firstly, we underwrite every transaction, and we underwrite a really wide variance of transactions. So everything from your big box purchase, your vacuum cleaner, to things you need to remodel your kitchen, tires, et cetera, as well as the things you want. So for instance, travel and experiences are an area we're seeing a lot more traction, over 60% year-over-year increase in that category. So this is really becoming a product that you can use as a better alternative to credit, no compounding interest, no late fees with us, and use for your whole array of wants and needs. So Competition heating up, it's fine with us. More consumers using this as a credit alternative and using safer products, another good thing for consumers and merchants, really.
I think that's well said. I think where we think of it as, when you think about competition, we're just continuing to take share from the credit card market. That's the biggest difference. The awareness level of the last couple of years, and again, thankful for the pandemic in some ways, not many, but in that sense of like it did increase a lot more adoption for us and awareness. And then ultimately what you find is we are seeing more of that wallet share off someone realizing, wait a second, why am I putting this on a credit card with interest? I can make these payments. This is reasonable. The interface, I think for all of us I'll speak for, is pretty clear in terms of transparency when the payments are coming in, it's clear. So we put you in a situation where it's a little bit of like, why aren't you doing this more than anything else? It's not adding more debt. It's simply, it's continuing to take share from what we see is a very expensive competitor.
If I can just expand on that, I don't see it as much of a competition against credit card. It's kind of a new invention that's been around for a long time, but now tech is added in. So if you look at to 2030, it should be about 10% of retail sales. So that's a huge, huge market. And for us, we work, and some of the new entrants that will come in will be traditional banks, right? Traditional banks, look at this product with a little bit of apprehensive because of a lot of different reasons. But we help banks build the technology to actually integrate into merchants to offer this. And banks will have the option to come in through this through Visa and also MasterCard. As you guys know, now the issuers are building out the capabilities to do this at the point of sale. LendIt has a partnership with MasterCard to actually help banks on board into this new bend that they built to do this. And so it's been slow, but we're starting to see a lot of increase in that. So in the future, when you swipe your credit card, you'll be able to pay in 3 or 4 payments or do a traditional credit card payment. So it's becoming more and more mainstream, and there'll be more and more options.
I would just quickly add, I think everything that we've just heard here is really saying this is solving a very specific consumer need that was unmet, right, with traditional bank products. And, we've just described a whole bunch of different definitions of buy now, pay later, quite frankly. We're talking about a card-based product. We're talking about, applying at checkout in real time, one transaction at a time. And I think buy now, pay later, when I think about what is the evolution of it, a lot of people think about pay in 4 as buy now, pay later, and that is very much evolving, right? I think buy now, pay later really covers the full spectrum of how is somebody financing this purchase in a slightly different way than they may have previously.
Agreed. Very, very interesting. And I'm going to come back to that comment in a moment, Mia. Let me just ask first, before we move too far from competition. I want to ask, and I'll start with Jeffrey, but please others chime in as well. We talk and think a lot about this from the consumer perspective, but I think we're seeing some evolution in a B2B perspective as well. And I'm wondering now, as Erica said, more entrants seem to validate this model. There's a need for this model. But I've begun to wonder, are we seeing relationships with retailers change as a result of more and more competition? Are we seeing, Jeffrey, for example, more incentives being used, or spiffs, or more negotiation about buying paper at a discount? What's the impact behind the scenes on commercial relationships of more competition?
Somewhat. I mean, the reality of it is the way the traditional BNP product is, it is expected to be interest-free, right? So, but there's a cost of that capital. It has to come from somewhere. So someone has to ultimately pay it, right? So if the retailer wants that option, it's going to have to pay, regardless if it's a traditional BNPL, a bank, or some new entrant. Now, there's always going to be some pressure when you bring in new entrants of how much do they pay and can they pay a little less. But given that what they want and need is like a robust kind of technological aspect, not just the capital, and that has cost to it. So there is some pressure, but I think historically I've seen a lot of pushback on lowering the fees at this point.
One word I've already heard a lot on this panel is options. And I think we're talking about it in the consumer context, but you just talked about it in the merchant context too. And fundamentally, that's what we find retailers are looking for. Consumers want more options. If you think about millennials just as an audience, they've been used to ordering their Starbucks 100 different ways, pretty much since they could pay for Starbucks. So they want more options when it comes to pulling out their wallet too, whether that's an old-fashioned wallet or an electronic one. Merchants are following the consumer, so they want to offer more options at checkout, but of course they also want to see the benefit of it. So we look at how we're increasing cart size for them. For us, it's about a 63% increase in cart sizes that we see for merchants, and that's what they're looking for. They're looking for new levers for growth that are beyond just using, a lot of Facebook advertising or Google advertising, which was sort of the last chapter in my mind, but that's, I think, what we're seeing with retailers.
I think the validation that we've seen over the last couple of years with this product increasing average order values and overall what's in your cart has made, I feel like there has been a shift the last couple of months in particular of, we now are seeking you out as much as we have our sales teams and we're reaching out to all these different retailers and potential partners. We're now seeing a lot more inbound than we typically would have expected, if I'm being honest, like over the past year, which is refreshing. It's just an acknowledgement that like this is a vehicle that the consumer does want to use.
Yeah, consumers are asking for it, right? And so the retailers are putting up their hand and saying, okay, I really have to understand this.
That's right.
But to your point, Erica, I think what the business case for the retailer is, do I have a high enough margin business that I can afford this as a customer acquisition channel? Increasing conversions, increasing average order value, and does the business case prove out, right? So that's a huge part of it too, as you're trying to provide this service to somebody, is does what is promised, does the 63% increase in cart actually play out for that particular merchant? And is the ROI there for them in paying a higher price for this kind of an acquisition channel?
Mia, let's keep going on the discussion of options, changes, and sort of the differences in what we all think of as BNPL. What are you seeing right now as sort of new and innovative, and what do you think we're going to be seeing here in the next couple of years?
Yeah, I think what's kind of interesting is, I talked about how really when we think about buy now, pay later, often people go directly to the pay in four. But so many companies, even the fintechs that started in the space and maybe started with pay in four, have now moved more and more into the longer term, higher ticket loans, right? So kind of the model of what consumers have gotten used to for those smaller tickets has now become kind of part of normal life and part of a normal flow and acceptable. So I think innovations like that, you talked a little bit about, just the pricing model and how those things will probably change given some of the macroeconomic factors that are going on. I think there's more innovation to happen there and some nuances within the options. Overall technology-wise, the fintechs got it right? They started this, they moved quickly, they built a fantastic consumer experience and user experience overall as well for the merchants. And really created this space of something that maybe consumers didn't even know they needed. And I think there's more of that to come as we keep tweaking the product and keep innovating against it.
Any other thoughts on sort of peering into the future and thinking about maybe what else we might see from other panelists?
I think part of it is the end goal for us is, are we able to, as Jeff said, there's a cost to what we do. We also have to make money as well. But how do we find as much of that from anywhere but the consumer as possible, especially around things like interest and late payments like that? We're all trying to avoid that and be a better solution. So the obsession is, can you increase efficiencies for this merchant to say this continues to be worth it for my time? So additional discovery. You knew we were going to mention AI at least once, So are there ways to be more predictive in what this individual needs based on their purchasing habits? And the more of that you can be predictive in saying, hey, you ordered this 2 months ago, it typically lasts 2 months, like is it time to reorder, things like that. There could be ways to really increase efficiencies and drive average order value, but in a way we're not forcing something on a customer, it's like we're understanding their behavior in a way that will make discovery more efficient.
Specific to Affirm for a moment, one thing I'm really excited about looking ahead is to drive a true omni-channel experience. This definitely, pay over time definitely started as an e-commerce modality mostly, but as it goes mainstream, going into a store, having a physical card or a card you can pull up in your wallet that you can say this payment method that I used and I loved when I bought something online, I can now use it in any store I go to. And think about, hey, if I can pay over time for this versus have that 30-day ball and chain with my credit card attached to me, then I'm going to do it. So I think that's really been a missing piece to more mainstream adoption. So I'm really excited about the launch of our Debit Plus card and the traction we're seeing there, because I think that's going to take things to the next level.
Great, thank you. Erica, in our last discussion, you talked a lot about consumer behavior, consumer psychology. Talk to us a little bit about the consumer mindset in BNPL. Sometimes you might hear that consumers are resistant to BNPL, or you might hear from another perspective that consumers take on too much BNPL. What are your thoughts on the sort of consumer psychology driving BNPL?
Yeah, this is a fun question. I'm just curious, audience participation, how many people have tried a BNPL product? And if you've tried it other than 6-week pay in 4 traditional format, can you keep your hand up or re-raise it? All right, so this is a fairly small amount. So anyone I've ever interviewed at a firm, I've asked them what their experience was using the product. And one of the anecdotes that stuck with me was someone who now works at the company saying, I thought I hacked the system. I didn't think this could be real. I got a 0% loan, bought their Peloton. It was like, I thought I cheated. I thought I made a mistake. And it's not entirely why I hired them, but it was validating. It's just that good. It's just that easy. And I think the psychology there is that a lot of consumers have felt a loss of control over their financial lives, over financial products that have worked against them over time, that haven't allowed them to pay on their schedule. And I think we're trying to re-earn some of that trust bit by bit, and also make it feel so easy and simplistic, but gotcha free. And that's a real switch for most consumers, right? Because you take that piece of plastic out, and there's a psychology of, ooh, if I can't sort of get to this in 30 days, then I'm really hosed. And we're trying to eliminate that fear and sort of say, we're on your side, it's okay. And I think the other dynamic is, last audience participation, was anyone afraid to tell anybody when they used their pay over time product? Like, did you tell anybody? So I'm curious, if I wasn't asking in interviews, sometimes I think people, when we do consumer panels and such, are a little embarrassed. And that's interesting, right? Because in theory, you've hacked the system, right? You found a better way. But I think eliminating that judgment and having people in an omni-channel context take out a card that says, hey, I'm clever, I found a way to do this on my terms, that psychology, that social acceptance is going to be a thing that I hope we uncover soon. But I personally find the psychology of it really interesting, because we're battling a lot of PTSD as it relates to traditional financial products.
And you wouldn't be embarrassed to tell somebody you used your credit card to pay for something. So why is this really any different, right? In fact, and I want to make sure that, when we're talking about the transparency factor here, you think about it from the consumer perspective, it is that cognitive load as they're checking out, as they're deciding to buy something, that lets them, in a really simplified way, right, say, can I afford $45 a month every 2 weeks, whatever the time frame is? That math is being done for them, and that sounds really super basic. But the reality is it lets them make that decision in real time as they're checking out. Can I or can't I? Can I afford this? Should I do this? How frequently do I get paid? What is my disposable income? They're not thinking about, well, this is going to show up on my credit card in 30 days, and what else did I put on there, and can I afford to pay the balance? So that simple nuance is that transparency that I think helps with the consumer decision as they're going through the flow.
Yeah, I'll just throw in just quickly too. We've seen too with the younger generations, the last two, the way they consume products, they rather pay for these over time as they consume them anyway. They're not really interested in ownership as much as we might be. So that's driving this as well, and that's why when you look at the percentage of the younger people using kind of BNPL, it's the lion's share, or the majority.
Jeffrey, I actually wanted to turn to you next and talk a little bit about your unique model where you're working to align a brand and a retailer and get all the systems sort of align together and think through, for the audience's benefit, how economic challenges now are changing that, and just sort of what it's like to build the co-branded type model that you're doing.
Yeah, it's whenever you're in an environment with rising interest rates, and you're dealing with capital, it becomes troublesome, right? So, give you an example. One of our largest programs, we do a program called Xbox All Access with Microsoft, but that was conceived about 5 years ago, a lot before this all happened. But that's a program in which you get the console, you get all the games and warranty wrapped up into one monthly price over 24 months, then you get upgraded. We run that program in 17 countries. We have about 10 different financial institutions and banks that finance that, and about 20 major retailers that carry it. Once you start going, you change the whole cost structure of it, right? And it's different in each country. It becomes more difficult. And then throw COVID in with the issues of getting chips in to build more consoles. It becomes a difficult thing. But the nice thing is when we work with kind of major brands and big banks, the great thing is we come together to solve problems. So through it all, we've been to 2 major, I would say, events that we got through, and everything's really stable now. And now what we start to see is that more and more brands are moving faster than they were pre-COVID to add these type of payment options in.
Thank you. Albert, I thought maybe I'd turn to you for this one. We're talking about a number of different changes affecting the marketplace. One is undoubtedly regulation. I know you straddle, you do some credit card stuff, you do some buy now, pay later stuff. What are you seeing as far as regulatory interventions? What do you think the CFPB and others may do with respect to BNPL, and how do you prepare for that?
I think they're in the audience. We can just ask. Just kidding. Good to see you. In all seriousness, so we aren't necessarily a credit card, but we aren't one, to be clear. We view ourselves from that lens because inevitably, if we think directionally from a regulatory perspective, you want to be responsible, essentially overcovered, frankly, when it comes to the consumer and making sure we're being responsible in terms of the proper disclosures, to make sure that's why we use you, actually, to make sure we are covered. What I think inevitably is going to happen, particularly, some things are possible because it's an election year coming up, but as this becomes a more mainstream product, inevitably, I think 2 things happen. One, I do believe we're a credit card competitor, and they see what's coming. So what does that mean? They're going to make a lot more attention around making noise around how are we behaving, and ultimately, making sure that their voice is heard in a way to make sure they're trying to slow us down in our innovations. But in parallel, it's probably just being thoughtful around the disclosures. Inevitably, as more people use us, there's going to be people that perhaps are not clear and financially responsible how to understand that what they're doing with this product. So are we being transparent enough? And we have to almost be obsessed with how we're being transparent on understanding what are your payments? Can you afford this? In our cases, we require down payments when you actually swipe the card initially. We want to make sure you can afford this. We do require to go into your bank account and understand what is the affordability and ultimately the income of who you are to make sure that we can do this. So we're starting to tweak our software and our application experience, which may lead to some friction if we're being honest, but around saying, can you actually afford this? And we actually think you can't, and this is what we will give you towards this product. So perhaps we can steer you to a different product that is similar to what you're buying or what you think you need. Because ultimately, as we get bigger, it's just realistically, it's a much bigger bullseye from a regulatory perspective, and it should be because we just have more customers or more of a market share than we would have. So when we think about it, are the proper disclosures there? Are we doing everything we can to make sure this customer can pay us back? So that's something that we keep understanding. Are people taking on more debt with BNPL? I don't think so. I think we're taking share from a behemoth competitor that overcharges. And the more we can get that clear in people's out there, actually, then I think we're going to see a lot more clarity. But we lead it from the perspective of obsessively thinking about affordability and making sure we're disclosing everything we could be possible to make sure that we're being as responsible a lender as we can be to you.
Great. So affordability, ability to repay, disclosures, transparency. Other thoughts from other panelists? I think those are great guidelines, but I didn't know if anyone else had any other thoughts on those.
My simple comment would be, you can self-regulate, right? Or expect that the regulators are going to tell you how to
Yes.
do it, right? And so I think, like everything, there's bad actors in every industry, and there's people that do it better. So as much as we can all be responsible and do it in a certain way, right? And make sure that we're caring for the consumer, I think everybody wins. I think as an industry, we win. You know, I think eventually the regulation is coming. There's certainly a lot of noise around it. The reality is most of that regulation is very much targeted back to, and I'm going to keep saying it unfortunately, is the pay in 4 market, right? It's everything else that's happening from a lending at the point of sale perspective, and you know, Affirm does it, others do it, is, you know, we're doing all of the normal things that you do in a regulated environment of lending at the point of sale, right? It's just a highly digital experience. It is really rapid. It's not, you know, paper and mailing in your credit card application from many years ago. It's happening in real time, which makes everyone nervous. I get it. But we're still doing all the same things, right? We're using FCRA data to underwrite. We are reporting to bureaus in many cases. So I think, again, there's a lot of very negative headlines that people tend to focus on, especially when it comes to buy now, pay later, and this, you know, CFPB and regulatory type of topics. But a lot of it tends to be about the pay in 4 market and things that are, you know, previously were flying a little bit under the radar.
Right. But I think, and this is a, you know, a credit to all the fintechs that made it so easy. But one of the issues of it being so easy is that the consumer, the average consumer, not realizing that it's a debt product, right? It is. I'm paying 4 and it doesn't cost me anything. That's great. But what happens when you don't pay? And what is that cost? And how long will those costs accumulate, right? So that's where you're going to see disclosures, requirement of disclosures around that major issue. The other thing, and Mia, you alluded to this, but there is reporting to the credit agencies, but what does that do to one's credit score, right? It's ambiguous. It may do nothing, it may do something. The credit agencies are not on the same page with it right now. And so they will come out and require that there be some disclosure around that it could, you know, negatively impact your credit score, even though you make all the payments on time. Just the fact that you take out this type of product, right? So that's an issue. And then also just disclosure around the privacy. Overall, I think, you know, these things are handled. California recently came out with new requirements for installment loans in California that required different types of disclosures, similar to what you see in Quebec. But, you know, everyone got on board pretty quickly. It wasn't a big deal. I think the same will happen here. Like you said, we've been doing this a long time, so we'll be able to add those disclosures in. As long as the customer experience is not you know, impacted too much, it shouldn't be too much of an issue.
Jeffrey, you touched on something a second ago that I think we want to probe just a little bit more, and that is very often when we talk about BNPL, we think about the customer transaction at the retailer, at the point of sale, at the time of the deal. What we don't talk about as much or hear about as much is the post-transaction servicing and the relationship with the consumer. How would you describe sort of the current state of play with respect to customer servicing, dealing with customers being late or defaulting, and how would you anticipate that changing over the next couple of years?
Yeah, I think you know, servicing, it's still, it's been the same for a long time, because at the end of the day, you have to try to go and collect your money. I think the big thing that we see changing is that once you have that customer, if it's in fact a good customer, you want to keep that customer, right? So what we spend a lot of time on is engaging the customer really at the end of the term, whatever term that they have, to buy more product, introduce them to other options. So that's the big thing. The servicing, we don't really do ourselves internally. We just supply the information so our partner banks can do the servicing. Mm-hmm.
On the servicing point, I think this is a great topic to bring up because keeping the consumer first is so critical when you're disrupting a space and trying to get them to change a behavior, change a payment modality that might be very unfamiliar. So we've really dedicated ourselves to coming up with consumer-friendly practices, paramount of which is no late fees. So we don't want people to be late, and we will annoy them a little bit if they are late, but we're not going to be punitive about it. And as more entrants have come into the space, seeing no late fees continue to be adopted by other players is really encouraging to us. But I think if you look into the future, a world with no late fees and pay over time and BNPL is a world we'd like to see.
I would just add from a merchant perspective, I think it's a balancing act, right? It still has to be viable for the merchant. It can't always be in favor of the consumer, but it's got a lot of similarities to the credit card business, right? We always err in the credit card business in favor of the consumer. It's usually the merchant that, suffers some friendly fraud and some other things, unfortunately. I think merchants and businesses have gotten used to that, right, wrong, or indifferent. But I think there's opportunity there too to make sure that, as the arbitrator between the merchant and the consumer, that, there's fairness and responsibility there.
Okay, I've got a few more questions for our panelists, but I just wanted to draw attention for everyone in the audience that the scan code is available for Q&A. We've got about 5 to 7 minutes to go, so if you're thinking about a question and you've been wondering when to go ahead and send it in, go ahead and scan that in and feel free to send your questions, and I'll continue with mine and then turn back to those. Next question, I'll ask Al this. We were just talking a little bit about servicing. I want to tie that into the economy a little bit. We're seeing prices go up, we're seeing inflation, we're seeing a number of challenges for everyday consumers. What are we seeing in terms of historical, say, default rates or late payment rates, and where do you think they're going given the economy? It's
a fair question. And look, it's a debate we have often, and I'm lucky where as an industry, I think a lot of the executive teams do communicate, and we're trying to understand, like, is there a pattern you're seeing that we have perhaps or not? But the short answer is, particularly for this type of customer, we aren't seeing this spike yet. And I have to admit, like, we thought it was. We took some precautions, including increasing our down payments for what we consider a riskier borrower, being very thoughtful around underwriting criteria and tightening it, ultimately to the detriment of our volumes at some point, while we kind of observe what we think is going to be a slowing economy. But I'm here to tell you, like, it's not impacting across the board. I mean, even the securitization's been looking good lately. Like, performance is there. That doesn't mean that we don't continue to be a little bit concerned. And I always joke anecdotally, like, I can't find certain service industries to save my life at the moment. Like, if I needed a plumber, it's very difficult because they're understaffed, right? And that's a common theme you're hearing. So when you think about our customer, we remain cautious. We've taken some views towards underwriting criteria and ultimately trying to be careful, right? Because it's important to protect our portfolio performance. That then leads to a better cost of capital, as you would imagine. So, long way of saying, my personal view, like, the macro is deteriorating, but we haven't seen it really show in a way, particularly for our customer, in a way that's meaningful at all. So we kind of remain cautious. We will remain cautious for the foreseeable future and hope perhaps it is just a muddle through. But at the moment, we remain as much as we can viewing it as a tightening credit environment.
Managing credit is definitely top priority for us right now. We actually saw DQs decline to 2.5%, as we reported in our recent earnings. I think that's definitely an output of us underwriting every transaction and saying, we're only going to extend credit that we believe can be repaid, and really sticking to that. But I think that ultimately, we're at a point in time where if you manage credit correctly and you're just extending it to those who can repay it, then you're going to see a stickiness effect. And we've already started to see that play out. About 88% of our current users are not first-time users anymore. So that's showing a flywheel effect if we continue to keep them in the system and extend credit responsibly.
Great. A question came up. It's actually gotten lost in the shuffle a little bit there, but I think the crux of the question was how do you define a credit challenged customer if you haven't pulled a credit report? I'll just throw it out to the group. If anyone wants to maybe talk a little bit about how you do underwriting, whether you pull a credit report, and if you don't, how you sort of grade the riskier consumers.
We do look at credit. And then we also require, again, as I described, affordability and income is important. So we require PLAD, right? So we go into your bank account, we want to understand what's consistent cash flow coming in. And this is not to give the borrower a poor experience or not give them what they want. It's putting them in a situation where we really can make sure that the affordability makes sense. Like, you can afford this product, and if not, we should be telling you no. And I'm yet to see a credit card company do that. They give you a blanket certain amount, and you just swipe away until the entire balance is maxed out, and then you're seeking help. Whereas that we, at the point of that sale, that in that moment of that transaction, we'll say yay or nay.
I think it's a misconception that even the early fintechs that started in this space are not pulling credit. Right. It may not be a hard credit pull, but there's certainly part of the decision is, can I find you? Do you exist? And are you credit worthy? They may also use alternative data, right? There may be thin credit, no credit customers that they'll use alternative methods to underwrite. But I think it's a misnomer to say, when you're not pulling credit, how do you assess? Most, and I would say all, are pulling credit.
Yeah, I would agree. And also, you have to have some kind of verification that the person is real, right? So that comes through credit and maybe even a secondary source.
Variations on the themes, but piece of the puzzle, not the whole puzzle.
Right.
Okay, another question I see in the questions from the audience are just, and I'll just expand the question a bit, but any thoughts on the CFPB's report and sort of maybe as a company or as a collection of companies, thoughts on responding and next steps?
I know as a trade organization, we've responded in some fashion, and I don't want to. I guess what I'd say is high level. I think while there was probably some very sharp points, I think we also have data. The data set was quite small. We thought the subsets. I think it's an ongoing discussion, and as this becomes less nascent and more available, I think there's gonna be a lot more data we can look at to understand, is this truly, incurring a significant amount of debt on these borrowers, which, again, I can't stress enough, the no interest component is, when I think about what payday is, when I think about what overdraft is, it's pretty disappointing that this is something that is not, even now, we always talk about it, but it's how is this okay for these borrowers that truly, in many instances, struggle towards the end of the month? Because what I've found is a lot of our borrowers, for that, I don't know the way to describe it, something bad happens to them often. And it's always I need this for my child or my pet or something else. So it's not just about buying the expensive sneakers. It's about being something there for them to support them in a situation where the alternative credit may be meaningfully much more expensive. So when you kind of think of it that way and view it as a product and a solution for the customer, I'd like to think it's not necessarily about, are they adding on debt? Again, I continue to think there's not enough definitive data to indicate that. There's small surveys, or people are saying it's hard to argue that. Well, why is that hard? I don't understand. We have data that points to this.
I'm noticing we have just a few seconds left, but we've been pretty consistent on admiration and respect for the work the CFPB is doing. And Mia made this point earlier, but regulation that is positive for the consumer and levels the playing field within the industry is, we think, a positive outcome.
Excellent, thank you. Well, audience, please join me in thanking not only Experian for hosting us, but also these panelists for the time today. Thank you.